Hey there and welcome. Today we're going to unpack a really fascinating framework from the team at Confidence Financial Partners. It's all about something they call diffusing the tax time bomb, and it's a way to help you see your retirement assets and the taxes that go with them in a whole new light. So let's dive in. So let's just jump right in with a pretty big question. After all those years of doing the right thing, of saving diligently, could there be a hidden liability lurking in your retirement accounts? It's something to really think about, especially as you get closer to or are already in retirement.
Well, that question leads us straight to a concept the confidence team has developed called the tax time bomb. Think of it like this. It's the potential tax bill that's quietly waiting for you on all the retirement money you've worked so hard for. Specifically, the money that you haven't paid taxes on yet.
So, how do you get your arms around this challenge? The advisors at Confidence use a powerful yet really simple visual tool called the tax triangle. It's basically a framework to help you categorize all of your assets based on one single critical factor: how they get taxed.
Okay, so the first corner of this triangle is what we call the always taxed bucket. This is where things like your traditional IRAs, 401ks, and thrift savings plans live. Now, you probably got a nice tax deduction when you put the money in, but here's the trade-off. Every single dollar you take out, whether it's you, your spouse, or your kids, is going to be taxed as ordinary income.
Next up, we've got the sometimes taxed category. This is for assets like your house or maybe a non-retirement brokerage account. With these, the growth might be taxed when you sell, but often at capital gains rates, which can be more favorable. And here's a really key feature: the potential for a step up in basis for your heirs. What that means is when they inherit the asset, its value for tax purposes gets updated, which could potentially reduce their own future tax bill quite a bit.
And that brings us to the third corner of the triangle, the one everyone's interested in: never taxed again. According to the Confidence team, there are two main places to hold assets that have this powerful feature: a Roth IRA and a properly structured cash value life insurance policy. The money in this bucket has already been taxed, which means qualified distributions are completely tax-free for you, for your spouse, and for your heirs.
So what does this tax time bomb actually look like for a lot of people? Well, take a look at this chart. It shows a pretty common situation where a huge chunk, we're talking 85%, of someone's retirement savings is sitting right in that always taxed bucket. You can see how that could be a problem. The fuse is basically lit, and a huge portion of that nest egg is exposed to whatever tax rates come down the line in the future. Okay, so you get the framework. But you might be asking, why is this so important to think about right now? Well, the advisors at Confidence suggest that the bigger economic picture gives us some really important context.
First, let's look at the U.S. national debt. The Confidence team highlights this figure of over $38 trillion. That's a huge number. And historically, when government debt gets high, policymakers often look for ways to increase revenue. One of the main tools they have for that is, you guessed it, taxation.
Now, at the very same time, the Confidence team points out that the baby boomer generation holds an incredible amount of this country's net worth, over $88 trillion. So when policymakers are looking for revenue, large pools of wealth, especially wealth sitting in those tax-deferred retirement accounts, can become a logical place to look. And this all leads to a really key perspective from the Confidence team. As they put it, the tax rates we see right now are at about 65 to 70-year lows. So when you put it all together, high national debt, a massive demographic wealth shift, and historically low tax rates, you can see the rationale for at least considering some proactive tax planning. So if you're looking at your own situation and thinking, wow, a lot of my money is in that always tax bucket, what can you do? Well, the Confidence team often discusses one potential strategy: systematically moving assets over to the never taxed again bucket. And one way to do that is through something called an incremental Roth conversion. So how does this actually work? Well, it's not a one-and-done thing. It's a deliberate process that can span multiple years. First, you figure out what you have in those always taxed accounts. Then, you decide on a strategic amount to convert each year, and you move it from a traditional account over to a Roth. Now, this next part is absolutely crucial to understand. This conversion is a taxable event. You have to pay ordinary income tax on whatever amount you convert in the year you convert it. This chart really lays out the core trade-off nice and clear. With a traditional IRA, you might get that tax deduction on the way in, but you pay taxes on the way out. With a Roth IRA, it's the opposite. You pay the tax now so that your qualified withdrawals later on are tax-free.
And there's another really key difference here to pay attention to: RMDs, or required minimum distributions. Roth IRAs don't have RMDs for the original owner, which can offer a lot more flexibility in retirement.
Now, of course, and this is a really big of course, tax planning is just one piece of the giant retirement puzzle. The advisors at Confidence always emphasize that any tax strategy has to be part of a complete, holistic financial approach. They have this fantastic saying for this: we're not going to let the tax tail wag the dog. What does that mean? It means that even though tax planning is important, it shouldn't be the only thing driving your entire financial strategy. It has to be balanced against your income needs, how you manage risk, and what your overall goals are for your life. This right here is what that holistic approach looks like in practice. The team's process covers what they call the 5 worlds of retirement. As you can see, tax planning is just one of these 5 critical areas. Any decision you make there needs to make sense with your plans for income, healthcare, and the legacy you want to leave behind. And that brings us right back to you. After walking through this framework, we want to leave you with one final and pretty powerful question to think about. What does your tax triangle look like? Really understanding the answer to that is the first step towards strategically planning your financial future.